Hi, welcome back. Today we'll cover an overall perspective on commercial real estate. I'm your host, BSHAHKARAMI, and let's get started. There are three types of basic investments. Number one is bonds, which is flat like pancake, and there's not much risk in it, so therefore there is not much reward. The rate of return is not high. Then there's the stocks and commodities, which most people are familiar with. This is the riskiest market of all three, but it could also have the highest return, but you could also lose a lot more. So no risk, no reward. And of course, there's the real estate market, which basically provides you a rate of return between bonds and the stocks and commodities, sometimes even higher than the stock market. So what's so special about the real estate market and why should I invest in it? There are three good reasons why real estate is a great investment opportunity. One is the diversification of income, so you don't put all your money in one basket. Two is you consistently receive that income. When you own a piece of real estate and you rent it out, you get a monthly rent payment coming to you. So consistency of income. And three, it's a passive income. So even if you don't have an earned income, meaning you're not working actively, you are receiving rent through a passive income on a monthly basis. That gives you independence. So you could be anywhere in the world, but still receiving that rental income. Speaking of income, there are three types of income. Number one is the earned income, which is the W-2 form, or you going to work every day. Number two is your portfolio income, which comes from stocks and bonds or commodities. And number three, of course, is the passive income coming from real estate and rentals. In my opinion, one of the best ways of making money. So let's start looking at things from a passive investment perspective or from a real estate investment perspective. With real estate, you're either in it or you want to get in it. You're either an owner or you want to be an owner. And we're going to look at things from an investor or an owner's perspective, because there are two ways of evaluating a property. One that's done by an appraiser and one that's done by the investor. Important to note that investors and appraisers don't always see eye to eye, and there's a good reason for that. Appraisers go out there and come up with the market value. That's today's market value. But investors, that's a different story. Investors use that market value as a tool in determining whether they should invest in a property or not. So sometimes they may pay a higher price than what the appraised value is. As an investor, you must do at least four types of analysis to come to your conclusion whether you should invest in something or not. Obviously, there's financial analysis, and they say with real estate, it's always location, location, location. So location and site analysis is another one. A third one is market and competitive analysis for commercial buildings or commercial space in general. And by commercial, I'm also talking about industrial. And there's always also the political and legal analysis that must be done. So while an appraiser just comes up with a market value, an investor may be looking at things for cash flow reasons or maybe looking at things for appreciation reasons. So if an investor is looking at a piece of property, whether it's a building or land, and knows that there's going to be a major highway maybe developing next to it, or maybe there's going to be major developments very close to the property, the investor can therefore deduce that there's going to be much appreciation in the coming years, maybe 5 to 8 years down the road. So therefore, an investor may be willing to pay a little higher price than what the market value bears. I used to always hear buy and hold long term. I am not sure that that is necessarily the case. It really depends on where you are in life, what your goals are. Are you in the wealth generation mode or are you in a wealth preservation mode? That also generally comes with age. So going back to why should I invest in real estate or capital markets? Well, there are four major reasons, four great reasons to invest in real estate. So there are basically four types of real estate investments. You have residential, which does not concern us here. You have commercial, and that could involve residential as far as apartment buildings. And you could also have commercial buildings, as you see in terms of whether it's retail or office buildings. And you could also have industrial. So when I say real estate here, we are discussing commercial real estate. What I mean by commercial real estate, it basically falls into three categories. One is the commercial buildings and restaurants and shopping centers that everyone is familiar with. Two is anything industrial, that's also considered commercial. And three is farm. Farm is considered commercial, although it is not on our plate for today. And there are four great reasons to invest in commercial real estate. And these four reasons have major impacts on your income. So number one is that commercial real estate, or real estate in general, provides you cost recovery recapture. That's depreciation. And that has a huge impact on what you keep in your pocket. Two, commercial real estate could have a very high internal rate of return or a rate of return or yield. Three, your leverage, your debt, your financing could have a huge impact on your rate of return and on the taxes that you pay, and therefore on your investment. Four is your taxes. Obviously, real estate is a great vehicle for reducing your taxes, and depreciation and financing are great tools for achieving this purpose. To make the right decision, you can't just wing it. You have to do some analysis. To do the analysis, you must start with a benchmark. You have to be able to measure things. Because, as they say, if you can't measure it, you can't manage it. And every financial analysis must start with a cash flow, because cash flow is king. And don't forget, in the land of the free, there is no free lunch. So why does it matter? It matters because it's not what you earn, it's what you keep. And what you keep is what you earn minus your taxes. So as an investor, your strategy should be to reduce your taxes and to defer them, and to do both of them at the same time if you could. And it just so happens that real estate is a great vehicle for doing this. Getting to the why and how is basically like solving a puzzle. And solving this puzzle for any type of investment must start with a cash flow analysis. Cash flow analysis is the main tool and provides the fundamental building blocks of analyzing the criteria on which an investment decision is made on. Here's a sample of these criteria. Your discount rate, how much you should be financing your debt, your leverage, what your net present value is, what is your internal rate of return, what is your capitalization rate or cap rate, what are you making on your cash or cash on cash, what is your cost recovery recapture or your depreciation, what is your effective tax rate. Because after you own the building, once you take the depreciation and the cost of borrowing, it effectively reduces your taxable income. So therefore, your effective tax would be much lower, or should be lower than your tax bracket. Once you know all this, depending on where you want to be, you may want to compare these investments through a net present value, through internal rate of return, or perhaps through wealth accumulation. Also, if you're a business owner, it helps you decide whether you should lease a building or whether you should purchase it. And it helps you do risk analysis. So here, there's a fork in your road. We go back to whether you're in it or whether you want to get in it. Whether you're already an existing owner of real estate or whether you want to purchase real estate and be an owner. If you're an owner, then these analyses would help you find out when is the right time to renovate, when is the right time to sell it, when should you hold for a few more years, when should you refinance and hold, when should you refinance and purchase something else, or when should you sell and lease the building if you're a user of the building, or whether you should just sell and buy something else, pay taxes on it and buy something else, or whether you should sell, pay the taxes and buy something else, or whether you should sell, and basically exchange it in a 1031 like-kind exchange. And if you're looking to buy, how do you decide where to buy, when to buy, what sector to buy in, how long to hold, how much to leverage, how much to finance, and again, whether to buy it or lease it? Most professional real estate investors know when they're going to get out of the real estate investment before they even buy it. Your president, Donald Trump, is one of them. So there's a fork in the road, depending on whether you're an existing owner or you want to be an owner. And each of these forks, the roads on this fork, takes different types of analysis. Thank you for your time. My name is BSHAHKARAMI with Commercial Investment Consultants. And if you have any questions, please send me an email and I will get back to you.